Amid all this market action between data, IPOs, MIAX set to go public today here at the stock exchange, and the great rate debate, I want to bring in Shelby McFadden, senior analyst at Motley Fool Asset Management. Shelby, welcome.
Thanks for having me. Great to be here.
Yes, great to have you indeed. And we should probably start here with the inflation data this morning. The producer price index coming in hotter than expected, up 0.9% in July from the month before. The reverse of what we saw with consumer inflation earlier this week that did come in slightly below estimates. What does this tell us?
Yeah, it's interesting. I think for one, we're still settling into the sort of new global trade environment that we're in. We've seen a lot of ups and downs with changes in tariff infrastructure and how that's affecting costs. So it's not surprising to maybe see a second round of pulling forward some of that advanced purchasing that we saw earlier in the second quarter. So I think that that's one side of the story. And then looking at the sort of bifurcation between consumer prices, well, consumer prices are kind of broken into some rate sensitive categories and then other things that are more just kind of pure retail. And so we've seen a little bit of slowdown in things like financial services, insurance, healthcare, some of that sort of deflation in those areas, but then other things, certain goods being a bit more expensive than services. So we're having that sort of break in between that section of things versus producers manufacturing, that's straight up hard assets there and materials. And so it's no surprise to see some of those things being a little bit more expensive, especially with the other movements that we're having in labor within the country.
So what does this mean for the rate debate? Because I think if we look at market action, it would imply this morning that hotter than expected inflation is sending stocks fractionally lower today, perhaps because it could cause some trepidation in the Fed's calculation of when to lower interest rates.
Yeah, I think when we look at PPI versus the Fed and we think about the fact that for them it's about inflation and unemployment, there is still a chance that this being a little bit warmer might not affect their decision. It really comes down to how this then affects the consumer behavior. So depending on how much of these increases end up being passed on to the consumer, I think determines whether or not we're going to see those cuts coming in October, or September rather. So there is a chance that we might see something like 25 to 50 basis points by the end of the year.
Yeah.
But if we see that sort of insistent heat come through to the consumer, it could stay frozen for a little bit longer.
How is the consumer faring to you?
Seems like they're doing pretty well. Now, there is a bit of a tipping point. We're not sure where that's going to be. So we know that things like student loans have come back, and they've come back fiercely. We do know that savings are a little bit low. We've also been tracking things like refis, cash out refis, things like that. HELOCs have absolutely skyrocketed. So the need for cash is high. And we're seeing that in the financing behavior. We're also seeing that microfinancing, where you're using buy now, pay later for $100, $200 purchases more often. But if you look at it from a sky high level, consumers are doing well. When you dig a little bit deeper, we realize that they're starting to leverage a little bit. So how long they're able to continue pumping the economy with cash, regardless of whether that cash has come from their direct deposit, their savings, or something like a HELOC, how long they're able to continue putting that cash into the system, I think will play a really big part in how long we see rates hover where they are.
Yes. So what all does this collectively imply for the market outlook?
I think for the market right now is that, one, prices are going to remain at a slightly higher level. And when we say that, we don't just mean what you see in the store. We mean the valuations in the market. There's a lot of cash and a lot of retail interests chasing the same amount of securities.
Yeah.
And so at the end of the day, that's really also how we track inflation, is how much demand is there for a fixed amount of product. So seeing that, I would imagine things will remain elevated. Real earnings, we might see them pinch a little bit. And we have started to see that. We started to see guidance, those windows narrow a little bit. But I would expect that the level overall is going to remain pretty elevated.
I do want to focus on one particular security that I think you're following, NYSE listed Toast.
Yes.
What are you watching for that stock?
Toast is really interesting. It's part of our TMFX product, which is our small and mid-cap growth product. And despite it seeming on the surface a little bit risky because it's very oriented toward consumer behavior, they have been able to fill a needed gap when it comes to small and mid-sized businesses in the restaurant space. And as consumers pinch their belts a little bit, have a little bit less, or interested in spending a little bit less on goods, they move towards services. Let's say they're traveling a little bit less, they spend a little bit more time at restaurants. And that's really attractive because they're able to provide a service that not only helps the restaurateur themselves, but makes the experience a little bit more valuable for the consumer. So they're more likely to come back, make those dollars a little bit more sticky. So it's something that, yes, it has to be part of the cycle. If spending comes down, sure, the rising tide and the fading tide lifts and sinks all boats, but they might be able to float for a little bit longer because of the value proposition of the product.
Shelby McFadden, Senior Analyst at Motley Fool Asset Management. Shelby, thank you.
Of course, thank you.
Yep.